Welcome back to another episode of Palisade Radio. I'm your host, Karem Mamutlu, and on today's show we have Tim Ord, who is the president, editor and publisher of the Ord Oracle and is frequently listed in the top 10 market timers within the US. How are you today, Tim?
Good. Thanks for having me on. We're looking forward to our conversation.
Well, as you're a new guest, let's begin by talking about your background and what led you to a career within the markets. And have you always viewed the markets from a technical perspective? What first drew you towards technical analysis, Tim?
Actually, I started out to be a stockbroker back in the 1970s, and technical analysis was kind of new back then, and I was a math major in college, and so my mind works more analytically than verbally. So I always had a knack for numbers, and but in early 70s and even 80s, technical analysis was not thought of as a very accurate method, but I thought it was. It's a lot better than fundamentals. Fundamentals to me didn't really make a lot of sense, so I kind of dove into it because I was a math major. Numbers made sense to me, and obviously, technical analysis is a lot of numbers. So that's the reason I went down that path and kind of pursued it. But my background's mathematics and technical analysis goes right down that road. So.
Well, let's talk about the gold market specifically then. I understand you're a believer in the cycle theory for the gold market, and I believe that there are two key cycles that appear to be very important when analyzing gold, and that's the 8-year cycle and the 16-year cycle. So can you give us some more details about this, and where are we potentially today for gold?
Actually, the 8 and 16-year cycle pretty much bottomed at the same time back in actually late 2015, early 2016. So according to those two major cycles, 8-year and 16-year, that was a major turning point in the market. And those cycles picked out pretty close to the 2000 low and basically the 1980, looks like about 87 low. Right now, both cycles are heading up. And 2016, the 16-year cycle, the half cycle, comes in around 2022, 2023, in that vicinity. And we think that area could be an important area for some sort of at least some sort of a major consolidation, if not even a top. So that's a 3 years out yet, so it's nothing to worry on a short-term basis, but that's the next major point, I guess, in my technical analysis, is where gold may form some sort of a high in the 20,000, 2022, 2023. So that's the next major point from here. So we'll have to wait and see. But the cycles right now are majorly up. Even though we may see multi-month consolidations, the bigger trend's up. And how high is high, we're not for sure yet, but since this is a major low, similar to 2000 low, we wouldn't be surprised if we go back to the old highs, not even break them. So in Elliott wave terms, we're thinking we're probably starting, or have started, which basically the last major low was August of last year. And this major cycle up, this major wave up right now, we think could be a 3 of a 3. If that's the case, this is probably the most powerful rally over the next 1 year, maybe 2 year time frame. So there's a lot of more energy going into the gold market right now, and even the cycles for the gold SPX cycles are turning up. So even though the S&Ps right now are still in a major bull market, the gold stocks, in our opinion, are started to outperform the SPX. And we think that may continue over the next couple of years. So there's a major cycle going on, and gold stocks really been beaten down. There's most of the gold stocks right now are pretty much penny stocks. So there's a lot of low price issues there, and we think that's going to change. So, but the year 2022, 2023 is an area to watch where a potential high could form. So, but that may change as time goes forward, but that's what it looks like right now.
Within the markets, not everyone believes how viable or relevant technical analysis is on getting on edge on where the markets might be going. So for you, Tim, do the technicals actually help to take out the emotion when reading a market? Do they help to keep you objective? But is there also a danger of looking at a chart and only seeing what you want to see and letting confirmation bias creep in? How do you get around this?
Well, actually, that's a good point. I do a lot of sentiment indicators. And it's really hard to keep your emotion out. A lot of times I do my best when I do my own work. When I start looking around from somebody else's work, it kind of influences me a little bit. So I try to keep my blinders on. And of all the indicators there are out there, the most accurate ones are momentum indicators. Momentum doesn't lie. If prices go up and moving average go up, that matters. And I don't care if it doesn't matter as long as momentum's going up. All the outside factors, the fundamentals, and or other bad news or good news doesn't really matter until prices, form a top and start going down, or prices form a bottom and start going up. So I always tell my clients momentum. So the first thing I look at is momentum. If momentum's going up, even though I do have indicators that suggest that maybe a top's not too far off, doesn't really matter until momentum, at least peaks out, goes sideways. To me, having a mathematical mind, I guess, I really don't get too emotional on the news that affects the market. It's the momentum of the indicators that keep me unbiased, I guess. So, which is kind of hard to do, but like I said, momentum price movement is that trumps everything else. So that keeps me on the right side of the market.
Very good. Okay, we've talked about technical analysis. So let's move on to the psychology of being in the markets and how you position yourself within a new bull market. So in your experience, how do you know when you are buying at the bottom of a new bull market? What indicators help you with this?
Well, that's a good question. We've seen some bullish, take gold, for instance, or actually gold stocks back in August of last year. The commitment of traders report for gold were net long, the first time I think it was in years. And momentum hasn't really turned up yet, but we did get long a little bit there, and we got out of our position, and we got long again back in January. The only reason why I went in and out, I needed momentum to turn back up. And momentum did go up for a while in August until I think it was November or December, and it kind of turned back down again. We got back out. And then the monthly charts, momentum monthly charts, which is basically the it was a 5-month, 9-month, and 11-month moving averages turned back up in January. And we got back long again. So when those three moving averages turn up, it's time on a monthly time frame. You're looking at a bigger rally that's going to last months, if not years. And so when those momentum indicators turn back up, we got back long again, and we're staying long, and the monthly charts are remaining long. But the signs back in August with the commercials, commitment of traders commercials turning bullish was a big sign for us that something important was about to happen. And it did happen. Even though August was a long ways from January, this on a monthly time frame. So we're looking at a signal that could last several years. So, again, momentum was the key here. We tried to position ourselves to stay long, but we got knocked out because of the daily and weekly momentums turned back down. But once the monthly momentum has turned up, we knew something big was about to happen. So that's one of the reasons why we're extremely bullish on a longer term basis here, because the monthly charts are on a buy signal.
Okay, as we're talking today, it'd be interesting to find out what writers or authors have influenced the way you look at the markets. Are there any recommendations you can share with our listeners?
Actually, the first book I read about technical analysis way back in the 70s was Edward McGee's Stock Trends. It's a book about patterns in the market. They talk about triangle patterns. They talk about consolidation patterns, just a bunch of different type patterns, what the volume, what should do in those patterns to confirm or deny what to expect next. That was a good pattern that got me on track. Actually, I do have a book out called Secret Science of Price and Volume, which actually keeps going on that direction, how volume reacts into patterns and what breakouts look like, what they should look like, signs of strength in the market, how to identify them, or signs of weakness, how to identify those. And that's all in my book also. Another good is the Weisskopf method. It's actually a course. Those people who created the course is dead, but the course is still out there, and it's more on volume and price also. Anything by Weisskopf is really good. And from there, I kind of developed my own. There's a lot of other books out there, but those are the three major books I think that are important, how the markets actually work. So those three methods will keep you on the right track of the market.
As we begin to wrap up the show today, Tim, is there anything else you wish to discuss or anything else on your mind at the moment?
The stock market, I guess we can talk a little bit about that. The S&Ps right now are probably, could be a little choppy here. No major top. We think ultimately the market will head higher, probably even 10% higher before the year's out, but the next 3 months could be really choppy. The gold market right now, I don't think the rally's quite done yet. We think probably even on a short-term basis, we can still head higher. On GDX, which is basically the ETF for gold stocks, we think it's probably heading to 31. And even though you may see a consolidation there, the bigger trends are still up. Like I said, probably gold and gold stocks are heading higher all the way into 2022, possibly 2023. And in bull markets, gold stocks outperform gold. So if you want the biggest bang for your buck, gold stocks would probably be a better investment than gold itself. Even though gold will go up, gold stocks will go up faster. And actually, there's another silver and gold ratio. In bull markets, silver really hasn't done a whole lot yet. Gold has. But in bull markets, usually silver outperforms gold. So between the two of gold, and if one wants to buy gold or silver, silver will probably be the better investment, even though both may go up. Silver will probably outperform gold, and that's what happened in the past. And the silver-gold ratio is pretty much rock bottom. It's about the lowest it ever gets. So silver should start to perk up here in the months to come.
Excellent. Okay, thank you very much for your time today, Tim. Much appreciated.
All right, thank you.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?